Okay, this is the first lecture that we're going to have in financial accounting, chapter 1 of the Kimmel book. This is Financial Accounting at Providence College, ACC 203, Summer 1 session. The very first chapter of this material is foundational in nature. It deals with some very basic business concepts. An overview to businesses, business structures, business entities. For those of you who do not have a business background, a lot of the material in this semester is going to be very new to you. A lot of the vocabulary is going to be very new. I've taught this course in the past, and I've had some medical professionals that are taking this class as a foundation to a certificate program or a foundational class with regard to getting an MBA. And especially for those people that business is not their discipline, these are all very new concepts. And in addition to the PowerPoint presentations, I strongly suggest that you read all of the material in the chapters to get that foundation, get that base of information. So what I'd like to do now is to begin with the PowerPoint presentation. And quite honestly, there's some material in here that we'll spend a little bit of time on. And there are many slides, there's roughly 62 slides to this first PowerPoint presentation. Some of these slides we'll just ignore. And I apologize for not deleting those slides beforehand, but nonetheless, we will skip them and I'll let you know what's not important. You know, what is important. Subsequent to this recorded presentation, there'll be another presentation where we look at some problems and some questions, and we'll read the problem, answer the question, and go from there. So let me share the screen with you, and this would be the PowerPoint presentation, and we will begin the slide presentation from the beginning. And again, this is introduction to financial statements with our textbook, the Kimmel 7th edition. Here are some of our learning objectives, and as I indicated, it's very broad in this very first chapter. Identify the forms of business organization. Those are the types of entities that we'll be talking about. In the uses of accounting information. One of the things that we will learn, and it's said a lot, but it is quite true, that accounting is the language of business. More importantly, accounting is the tool that is used to communicate information to the various stakeholders, not stockholders, stakeholders. We'll talk about that in a few minutes. Communicating information is a great deal of information. We'll spend most of the semester talking about what that information is. Second learning objectives, explain the 3 principal types of business activity. I'm going to spend a little bit of time on that, not a lot. And most importantly, describe the 4 financial statements and how they are prepared. I'm going to spend a great deal of time on that, specifically 3 of those 4 financial statements. Here's our learning objective 1, identify the forms of business organization and the uses of accounting information. So we have the forms of business. We have a sole proprietorship. This is very simple to establish. Many very small businesses initially start this way. It'll be a single owner who has an idea for a business, and this person starts a business. Maybe it's a part-time business. Maybe this person has a full-time job and they have an idea to start a business, and they do it at night after work and on the weekends. And really, it's a very simple from an accounting perspective. I'm going to talk about cash collected and cash going out. Again, very simple. It's owner-controlled, 100% by the owner. There are significant tax advantages to this. Which is beyond the scope of this class, but fundamentally speaking, many types of expenses can be deducted. There is a second type of entity is a partnership. Again, simple to establish. No filings with secretaries of states in the states of Rhode Island, but the primary difference between a sole proprietorship and a partnership is the number of people that are involved. A sole proprietor is somebody who is just one owner. A partnership, you're in association with more than one owner. It could be 2 people, it could be 100 people, it could be 500 people, it could be 1,000. Shared control. The various owners control the direction and activities of the business. Broader skills and resources means that you got more people involved, more things can be done. There again are tax advantages which are beyond the scope of this class. A corporation is probably what most people are most familiar with. Many of our largest entities, largest businesses are in fact corporations. Easy to transfer ownership. What does that mean? Well, when a corporation is formed, there is an initial transaction where the owners will contribute cash into this corporation in exchange for stock certificates. Stock certificates are evidence of ownership. And once that person has that stock certificate, he can or she can sell it, transfer it as he or she wishes, hence the stock exchange. Okay. Easier to raise funds because, in fact, a corporation is a legal entity. A corporation has to be established, has to obtain permission through a filing with a Secretary of State from the state in which it's organized. And a corporation is a legal separate entity from its individuals. There is no personal liability. The corporation has the liability, unlike the other 2 types of entities, sole proprietorship and, partnership. The liability is shared with the owners. So there are various activities that goes on within the company. Questions asked by internal users is some financing activities. Is cash sufficient to pay dividends and to pay the bills? Marketing, what price should Apple charge for an iPhone or maximize the company's net income? Management of the company and human resources. So these are 4 of the big activities within a business. Management, how the company is run. Human resources, how are the employees taken care of? Marketing, how do we let people know about our product and know about our company? And finance essentially is accounting, how do we pay the bills? How do we collect the cash? Accounting across the organization, owning a piece of the bar. The original Cliff Bar, many of you are familiar with Cliff Bar, Energy Bar, was created in 1990 after 6 months of experimentation by Gary Erickson and his mother in her kitchen. Today, the company has approximately 1,000 employees and is considered one of the leading Landor's breakaway brands. One of Cliff Bar & Company's proudest moments was the creation of an employee stock ownership plan. This plan gives its employees 20% ownership of the company. The employee stock option plan also resulted in Cliff Bar enacting an open book management program, including the commitment to educate all employee owners about its finances. Armed with basic accounting knowledge, employees are more aware of the financial impact of their actions, which leads to better decisions. Point of the story is Cliff Bar started as a sole proprietorship by Gary Erickson and his mother in the kitchen. So maybe Gary started it by himself. Maybe at some point later, there was a partnership between Gary and his mother. And then at some point in time, the company got much bigger and they incorporated and brought in many other stockholders. So external users. So we talked about internal users. Those are the people within the company. Here are external users. External users are investors, people who are thinking of investing, buying the stock of that company. Creditors are people who lend money to that company, such as a bank. Bank loans money to the company, they're a creditor. And then investors, how does Disney compare its size and profitability with Time Warner? So the two significant external users are investors and creditors. How will the study of accounting help you? A working knowledge of accounting is desirable for virtually every field of business. Some examples of how accounting is used in business careers follow. General management, managers of Ford Motors, Massachusetts General Hospital, all these companies, and Trek Shop all need to understand accounting data in order to make wise business decisions. You take an accounting course not necessarily to become an accountant, but to understand the information that is made available to you. Some people say that accounting is the language of business, and as we're going to see all semester long, that what we will learn how to do is record transactions. Accounting is about recording transactions. Every day there are trillions of transactions that occur in the business world. And the question is, how are they recorded in the system? So we're going to spend all of our semester, all of our 5 weeks, learning how to record, learning how to process these business transactions. Every single business transaction results in a journal entry. Journal entries, debits and credits, which we're going to learn a great deal about as we go forward. So we go back here, we talked about general management, we talked about marketing. Marketing specialists at Procter & Gamble must be sensitive to cost and benefits, which accounting helps them quantify and understand. Making a sale is meaningless unless it is a profitable sale. Finance, do you want to be a banker for Citigroup or Citicorp, an investment analyst for Goldman Sachs, or a stockbroker for Merrill Lynch? These fields rely heavily on accounting knowledge to analyze financial statements. In fact, it is difficult to get a good job in finance without 2 or 3 accounting classes. Real estate, are you interested in being a real estate broker for Prudential Real Estate? Because a third party, the bank, is almost always involved in financing a real estate transaction, brokers must understand the numbers involved. Can the buyer afford to make the payments to the bank? Does the cash flow from an industrial property justify the purchase price? Again, accounting information is important to understanding how businesses work. Ethics in financial reporting. United States regulators and lawmakers were very concerned that the economy would suffer if investors lost confidence in corporate accounting because of unethical financial reporting. You may have heard of examples of Enron and WorldCom, companies that went under because the managers of that company manipulated the financial information to their advantage. There was many laws passed. Sarbanes-Oxley was one of them to try to halt that. Effective financial reporting depends on sound ethical behavior. Are the managers, are the accountants ethical? Ethics in financial reporting. Recognize an ethical situation and the ethical issues involved. Use your personal ethics to identify ethical situations and issues. Is it right? Does it seem right? Once you become educated in accounting, you will be able to make those decisions. If it doesn't feel right, it probably isn't. Identify and analyze the principal elements in the situation. Understand or identify the stakeholders. Who's a stakeholder? A person or group who may be harmed or benefited. Stakeholders are people who have an interest in that company, not necessarily the stockholder. A stockholder is someone who owns part of that company. Could be a creditor, someone who has loaned money to that business. Could be the employees of that company. Again, ask the question, what are the responsibilities and obligations of the parties involved? Identify the alternatives and weigh the impact of each alternative on various stakeholders. Select the most ethical alternative considering all the consequences. In other words, what are the appropriate actions? Some situations involve more than one right solution. These situations require you to evaluate each alternative and select the best one. Here's an example. Ethics Insight, Dewey, LeBoeuf, LLP. I felt the pressure. Would you? I felt the pressure. That's what some of the employees of the now defunct, it's gone away, law firm of Dewey, LeBoeuf, LLP indicated when they helped to overstate revenue. Overstate, misstate revenue. Revenue is cash collections, if you will, and use accounting tricks to hide losses and cover up cash shortages. These employees worked for the former finance director and former chief financial officer of the firm. Here are some of their comments. I was instructed, here's an employee working for the CFO, I was instructed by the CFO to create invoices, knowing they would not be sent to clients. When I created these invoices, I knew that it was inappropriate. Your boss tells you something to do. Your boss tells you to do something, what do you do? I intentionally gave the auditors incorrect information in the course of the audit. What happened here? A small group of lower-level employees over a period of years carried out instructions of their bosses. Their bosses, however, seemed to have no concern, as evidenced by the various emails with one another, in which they referred to their financial manipulations as accounting tricks, cooking the books, and fake income. So here's some questions regarding business organizations. In choosing the organizational form for your outdoor guide service, you should consider the pros and cons of each. Identify each of the following organizational characteristics with the organizational form or forms with which it is associated. Easier to raise funds, a corporation. Simple to establish, well, that's going to be a sole proprietorship and a partnership. No personal liability, corporation. Remember, sole proprietorships and partnerships don't have a corporation, a legal entity, protect itself from its owners. Tax advantages generally go to sole proprietorship and partnerships. Easier to transfer ownership, corporation. Which of the following did not result from the Sarbanes-Oxley Act? Top management must now certify the accuracy of financial information. Yes. Penalties for fraudulent activity increased. Yes. Independence of auditors increased. Yes. Tax rates on corporations increased. No. Okay. Which of the following did not affect taxes on corporations? Dealt with how people acted primarily. Learning objective number 2. Explain the 3 principal types of business activity. We're going to spend a little bit of time on this, not much. Because a lot of this is going to be picked up if you take financial accounting, if you take managerial accounting, ACC 204 at Providence College, where we talk about preparing the statement of cash flows. Statement of cash flows has 3 principal activities: financing activities, investing activities, and operating activities. We're going to talk about what those are because they are helpful in understanding the functions of a company. The accounting information system keeps track of the results of each of these business activities. Accounting information system can be something simple as an Excel worksheet. You may have heard something about QuickBooks. QuickBooks is a relatively inexpensive accounting system that helps people efficiently prepare important financial documents. Financing activities, borrowing activities. How does a company finance itself? They borrow money. One primary source of outside funds borrowing money. Amounts owed are called liabilities. Party to whom amounts are owed are creditors. Notes payable and bonds payable are different types of liabilities, which we'll see at the end of this chapter, not this chapter, but in the end of the course. We see study notes payable and liabilities more often. Another way that a company can raise money besides liabilities is issuing stock. Second primary source of outside funds, issuing or selling shares of stock for cash. Somebody contributes $1,000 of cash into the corporation, they will receive as an investor a share of stock. Common stock is generally what we're going to see. The amount paid by stockholders for shares they purchase. It entitles them primarily to dividends, a return on their investment. Investing activities. What does the company invest in? Purchase of resources of which a company needs to operate. Resources owned by a business are called assets. Example of these investing activities: computers, delivery trucks, furniture, buildings. Things that provide long-term economic benefit to this business entity over a number of years. Again, computers, buildings, trucks, furniture. They can also invest in other companies. They can purchase the stock of another company. Those are two primary investing activities. Operating activities. The operations begin once a company acquires assets. And the two principal operating activities are revenues and expenses. Revenues are generated, amounts earned from the sale of products and other sources. Sales revenue, service revenue, interest revenue, rental income are all examples of revenues. Inventory is an asset that consists of goods available for sale. Inventory, the stuff a company buys to resell. Accounts receivable are the right to receive money from a customer as a result of the sale. Operating activities also include expenses incurred to earn revenue, such as cost of assets consumed or services used, cost of goods sold, selling expenses, marketing expenses, rent, employee salaries. Liabilities arise from expenses. Talk about those later. Results, net income. When revenues exceed expenses, net loss when expenses exceed revenues. And what we're going to find out when we look at the income statement is revenues, that is collection from customers, less expenses paid, if you will, equals net income. Revenues minus expenses equals net income. Classify each item as an asset, liability, common stock, or revenue or expense. Cost of renting property, an expense. Truck purchased, it's a long-term resource. It's going to be an asset. Notes payable, it's a liability. Issuance of ownership shares, common stock. Amount earned from performing services, revenue. Amounts owed to suppliers, also payable, it's a liability. Learning objective 3. Describe the 4 financial statements and how they are prepared. I'm going to get a lot of practice doing this. The 4 financial statements. Companies prepare 4 financial statements from summarized accounting data. I'm going to spend a lot of time talking about the accounting cycle. Here are the 4 basic financial statements. Income statement. Revenues minus expenses equals net income. Retained earnings. Retained earnings statement. I'm going to spend time on that. The balance sheet. Assets, liabilities, and equity. And the statement of cash flows, which we will not be preparing this semester. Here's an income statement. Now, let's look at it carefully. And what we see here is the Sierra Corporation, and it is the income statement, and it is for the month ended October 31st, 2022. That's the title. The title is very important. Number 1, it tells you the name of the company. Number 2, it tells you which financial statement you're looking at. And number 3, it tells you what period or what time frame you're looking at. This is an income statement. An income statement is for a period of time. Revenues less expenses for a period of time. It's defined here as the month ended October 31st, 2022. Revenues have service revenue. They've got various expenses, salaries and wages paid to their employees, rent expense, supplies expense, depreciation expense, interest expense, insurance expense. $10,600 of revenue less $7,740 of expenses. Net income equals $2,840. The income statement reports revenues, expenses for a specific period of time. Net income, net loss, we just talked about that. Statement of retained earnings. So before we go into the details of what it is, the statement of retained earnings is the retained earnings by the corporation, also known as the undistributed profits to the owners. Remember, the shareholders own the stock of the company. The shareholders own the profits. Corporations don't distribute all of the profits because they need them in terms to expand. So retained earnings, the profits that have been retained by the company. Retained earnings are also the undistributed profits. So in this case, the company was formed on October 1. They had 0 retained earnings. Going to add the net income to it. And then they're going to subtract dividends. Dividends are the distribution of earnings to the shareholders. So you can see this statement of retained earnings here, that the profits were $2,860. They distributed some of that profit to the shareholders of $500. They have ending retained earnings at October 31st of $2,360, or undistributed profits of $2,360. So you can see the relationship between the income statement and the statement of retained earnings. On the left-hand side, you see the income statement, revenues minus expenses. On the right-hand side, you see the statement of retained earnings, and you can't prepare the statement of retained earnings until you have prepared the income statement. So the very first financial statement that's prepared is the income statement, so that you have net income. And the net income transfers over to the statement of retained earnings. Here's a balance sheet. In a balance sheet is a statement of assets, liabilities, and equity accounts at a point in time. Let's look at the title, name of the company, Sierra Corporation. Which financial statement are we looking at? The balance sheet. And what's the period of time? Well, balance sheet is at a moment in time, as of October 31st, 2022. And you're going to see that the balance sheet is broken down assets and stockholder liabilities and stockholders' equity. And what we will learn in another chapter, the accounting formula is assets equal liabilities plus equity. In our example here, we have cash, accounts receivable. We're going to define all these things at a later point in time. Total assets, $21,910. And then we have our liabilities. Total liabilities of $95.50. Stockholders' equity, which also includes retained earnings from the statement of retained earnings of $23.60. We have total liabilities and stockholders' equity of $21,910. Assets equal liabilities plus owner's equity. Balance sheet reports assets and claims to assets at a specific point in time. Here's the accounting formula we just talked about. Assets equal liabilities plus stockholder equity. Again, here's the relationship between the statement of retained earnings and the balance sheet. You can see where, again, we have to prepare the retained earnings statement before the balance sheet. So the order of preparation of financial statements. First, you prepare the income statement, then you prepare the statement of retained earnings, and then you prepare the balance sheet. The fourth financial statement you would prepare is the statement of cash flows, which we're not going to do this semester. Here's the statement of cash flows. No need to worry about this. We're not going to do it. I'm not going to talk about the statement of cash flows. Let's talk about some questions. Financial statements. Review question number 1. Net income will result during a period when assets exceed liabilities? No. Assets exceed revenues? No. Expenses exceed revenues? No. D, when revenues exceed expenses. Revenues minus expenses equals net income. Question 2. Which of the following financial statements is prepared as of a specific point in time? B, C, and D are all for a period of time. The balance sheet is only at a moment in time. Not going to talk about that. Let's do some examples. CSU Corporation began operations on January 1, 2022. The following information is available for CSU on December 31st, 2022, a year later. Now, what you have here is a bunch of accounts. Some of them are assets, some of them are expenses. What they want you to do is prepare an income statement, a retained earnings statement, and a balance sheet. So you need to have an understanding of what goes where, okay? Revenues minus expenses go on the balance sheet. That net number, net income, then goes to the statement of retained earnings, and you subtract dividends. The balance sheet has assets, liabilities, and equity. Okay, so let's take a look at some of these accounts. Let's kind of sense of what they are. Let's first identify the items that would show up on the statement of net income. Working on the left-hand side, looking down, there's nothing there. On the right-hand side, insurance expense, that's an expense. Service revenue, supplies, it's an asset. Supplies expense is an expense in cash. So here's our income statement. Service revenue. We have expenses. Let's go back and look for that $9,000. Where's that number? Rent expense. See? The columns are a little off, right? You see that, right? The rent expense should be $9,000. The insurance expense should be $1,000. The supplies expense is $200. It's misaligned here, okay? But revenue minus expenses, $6,800 of net income. So we need to prepare the statement of retained earnings. Now, we look at this page here and see retained earnings is a question mark. So remember, this company just started, began operations on January 1, 2022. Brand new company. When it starts out, it has no undistributed profits, has no retained earnings. So the beginning balance is 0. Let's remember the basic format, the statement of retained earnings. Beginning retained earnings plus net income less dividends equals ending retained earnings. And that's what we see here, right? Retained earnings, January 1, 0. Just the company just started, has no retained earnings. The net income number comes from the statement of net income, which we just worked with, $6,800. And there's the dividends of $600 that was paid out. We go back here, second column on the bottom right, dividends paid out, $600. Less dividends. So statement of retained earnings, ending balance, $6,200. They want us now to prepare the balance sheet. Accounts receivable is an asset. Money that is owed to the corporation. Accounts payable, it's a liability, amounts that they owe out. Rent expense was on the income statement. Notes payable, a liability. Common stock, equity account. Equipment, an asset. Next column, supplies. Doesn't have the word expense, it's an asset. Cash, an asset. Here's my balance sheet. Cash, accounts receivable, supplies, equipment. $23,200. The liabilities, notes payable, accounts payable, common stock. There's my retained earnings, right? Let's go back, let's look. Retained earnings, December 31st, $6,200. Equity, $16,002. You know you got it right. Pardon me, you know I got it right when they balance. When total assets, $23,200, equal liabilities plus owner's equity. That's the heart of what we're going to do all semester. Going to prepare journal entries to get us there. We'll talk about that later. There are some other things that show up in the annual report of a company. What's in the annual report? An annual report is a document that the corporation prepares and distributes to at least the shareholders. They include other things besides the finance. U.S. companies that are publicly traded must provide shareholders with an annual report. The annual report always includes the financial statements. Income statement, statement of retained earnings, balance sheet, statement of cash flows. There's also management discussion and analysis. Explains what happened, what might happen going forward. Notes to the financial statements. Footnotes, if you will, explaining various types of items that are required by generally accepted accounting principles. We'll talk about that later. And then there's an auditor's report. You may have heard that. An outside accounting firm comes in, performs an audit to make sure the numbers are reasonable. There's going to be a report that's attached to this document. Those are the key elements of an annual report. Elements of an annual report, management discussion. I'm not going to talk about a lot about that. Not going to talk about that. Skip this. Here's an example of a footnote. Columbia Sportswear company notes the financial statement. Revenue recognition. What are the company's policies in terms of recognizing revenue? We record wholesale, distributor, e-commerce, and licensed product revenues when title passes and the risks and rewards of ownership have passed to the customer. Title generally passes upon shipment to or upon receipt by the customer, depending on the terms of the sale with the customer. Retail store revenues are recorded at the time of sale. Footnote explains how they record revenue. It is not when the cash is collected. It's when title passes. An auditor's report. An auditor's opinion as to the fairness of the presentation of the financial position and results of operations in their conformance with generally accepted accounting principles. Only certified public accountants, CPAs, may perform audits. Here's an excerpt from the auditor's report. In our opinion, such consolidated financial statements present fairly, not accurately, fairly, in all material respects, the financial position of Columbia Sportswear Company and its subsidiaries, et cetera, et cetera. Also, in our opinion, such financial statement schedules, when considered in relation to the basic consolidated financial statements taken as a whole, presents fairly in all material respects the information set forth therein. In his opinion, fairly represent. Skip that. Skip that. Not terribly important. And we're not going to talk about international financial statements. So let me stop sharing this. That's essentially chapter 1. I know we went through it pretty quickly, but it's foundational in nature. We introduced you, the most important things here is that we introduced you to the major financial statements. The ones that we're going to be working with in this class are the income statement, statement of retained earnings, and the balance sheet. In other chapters, we're going to spend a great deal of time learning how to record transactions into our accounting system that will ultimately result in the preparation of those financial statements. So that is it for chapter number 1. Thank you very much.